Hello, thanks for joining me again today. We are going through the financial pyramid, and today we are going to be again sticking out on the manage your lifestyle, spending a lot of time here, and doing another section on debt and credit. The more I dug into this to try to put it into bite-sized pieces, the more I realized it was difficult to put it into bite-sized pieces. So we've gone over some of the credit things. We've gone over some of the things that the banks look at or the lenders look at when they're trying to determine your ability to get credit and your ability to pay credit. And now we're going to look at some of the strategies we can use when we are trying to repay credit. That's the other half of the equation. So again, to remind us all, debt is the money you owe and credit is the money you can borrow. So if you have a credit card and there's $20,000 available, but you haven't used any, then you've got credit, but you don't have any debt. If you've got a credit card and it has a $20,000 balance, you have debt. So it's just two sides of the same equation. And when we're in control of our debt, as I've stated before, it's a valuable tool to help us move forward in our lives. And it can actually accelerate our growth and the achievement of our goals. We can manage emergencies, build our businesses, etc. When you're considering taking on debt, you may get approved up to a maximum. And will that leave you with enough disposable income to live life comfortably? Often people will get approved right up to a max on their mortgage and then can feel a little constricted at the end of every month because there are other things that maybe they didn't fully understand what the expense of living in their own home would be. So things like that. And also, do you have enough emergency savings or any insurance in place to deal with the unexpected? We'll touch on that a little further. So if you're feeling overextended, you're not alone. According to Statistics Canada, there is $1.86 in credit market debt for every dollar of household disposable income. That means that we are owing more than we are making by a long stretch. And people also have different reactions to debt. You could be debt averse or you could take on too much debt, and you really have to know yourself and what your level of anxiety is around debt and how realistic you are being when it comes to paying back the debt, etc. And just because you can doesn't mean you should. So there's a lot of credit available. You're probably always getting offers for credit cards, a line of credit, etc. You really have to be strategic in the way that you're using it. It's convenient to use credit. It's easy to lose track, and you can get in the habit of being in debt as if it's a normal thing. For instance, I have a credit card payment. Okay, so it's not a payment. It's not like paying your utilities. It's something you owe. So even that little shift is one to be aware of. What are the risks of being overextended? So while you're able to service your debt, if everything goes okay, if something goes awry, it can quickly spiral out of control. And then we're, a couple of short steps away from really being in trouble financially. So what are those risks? Losing a job, getting sick or injured, interest rates increasing, causing your debt payments, anything that's not on a guaranteed interest, anything like that is going to cause your payment to increase. Anything out of the ordinary, like replacing a furnace or doing a car repair you hadn't expected or having to fly out of town for a family emergency. All of that means increasing stress and a huge financial burden if you're not in control. So here are some debt repayment strategies. It's funny that the first three I'm going to mention all have to do with snow. I'm not sure why. One's the avalanche, one's the snowball, one's the snowflake. They all have different uses, and you can go online and you can research these. And one of the things that you will find is that often people will tell you, this is the right one to pick. You really do have to know yourself though and know what's going to work for you. So that's something to be aware of as we're going through these strategies. There's also consolidation and refinancing, including using traditional mortgages to refinance or lines of credit. So the Avalanche Method. This method pays off the highest interest rate debt first, and you make minimum monthly payments on everything else. So once the first debt is paid off, you take that number that you were paying and you roll it into the debt with the next highest interest rate. Okay? So you're always stacking it. It becomes like an avalanche. So you can save money on interest and you can pay off your loans faster, all of the loans. Now, it can be hard to stay motivated, especially if it takes a really long time to pay off the first debt. And particularly if the high interest rate is combined with a large balance. So put those two together and it can, feel like you're not making a lot of headway. So you've got to be aware of yourself and know how to keep yourself motivated. The snowball. So you pay off the smallest obligation first, and then the repayment funds are applied to the next smallest, and so on. So this is tested, and it does line up well with behaviors because there are quick wins that provide a sense of accomplishment. Now, it can take a little bit longer to pay off debt, and because of that, you could end up paying a little bit more interest. So you've got to balance that. What's going to keep me on track with how much interest do I want to pay? So what's the snowflake? So if there's no available cash flow, so you can't cut anything back, you're living at the end of your means at the moment. So anytime there's any found money, you put it on a debt. So like selling things on eBay or Kijiji or having a garage sale, any bonuses, unexpected bonuses, a lottery win, and I'm talking about like a $5 or $10 lottery win, because what do we normally do with that? We normally just buy another lottery ticket. And that $5 you found in your jacket, from last fall, if you use cash and you collect the coins, then use those coins to start paying down some of that debt. So it works with a limited cash flow, and the small steps can make a difference. It may be inconsistent, and it could take a long time to pay down debt. So if there's no opportunity to expand your cash flow, either, getting an extra job or whatever it is, then this can be something that can get you moving incrementally in the right direction. So consolidation and refinancing. So think of consolidation as simplifying a debt. So you're taking multiple loans, you're rolling them into one loan, and you're making it easier to manage one payment. There's not necessarily an improved interest rate, but it is easier to manage. And then think of refinancing as you're optimizing the debt. So you're creating a new loan. So you're typically refinancing. You may be extending out the term, but you're refinancing at a lower interest rate. It does free up cash flow and is really, really important when you're freeing up cash flow to make sure. So one thing to really, really pay attention to when you're doing any consolidation or refinancing, if you've got freed up cash flow, make sure you've given that money a job to do. So whether you're paying down the debt, whether you're saving for emergencies, whether you're saving for a short-term goal, whether you're investing some of that money, give it a job. Otherwise, you could just end up right back where you started because you're considering that that money is now a windfall. And if you've been under financial pressure, then when we relieve the financial pressure, it's like, whew, what can I do now, right? So make sure you're giving it some jobs to do, and just be aware of what your behavior has been in the past. And this is an opportunity to do a reset, right? So when you've got some equity in the house, it may be a possibility to refinance. So you're rolling your debt in on top of your mortgage and you're saying, okay, I'm going to get a new mortgage. And often you could be extending out that term to make the monthly payment more affordable. You've got to be aware that you're going to get approved up to a certain limit. And also, take a look at other things that are affected by that decision. So for instance, if you've got insurance that you thought your mortgage was going to be paid off in 15 years and now it's going to take 25, might be time to review some of those things. So always look at the decisions you're making in concert with the way that it could affect other things in your life. So just don't look at it as one little item. Think, okay, how is this going to affect the other areas of my financial life? You could also get a home equity line of credit. So you may be able to refinance your debt by using equity in your home. And if you've got some equity in your home, that's fantastic. Typically, you're at a lower interest rate. It could be a variable interest rate. So just pay attention to that because, interest rates go up and down. And there is that risk of never paying down the balance. So you're only always paying that interest. And it just feels like, oh, this is just what I have to pay every month. So just really be aware of that. So get the advice you need and really know yourself. I'll say those two things again. Get the advice you need and really know yourself. So spend some time. It can take a bit of a deep dive to understand your relationship with money and your relationship with debt. And talk to an advisor who understands debt restructure, understands the options available, can have a conversation with you about what your relationship with money is. And once you've, again, paid down that debt, find the jobs for the money. So give that money some work to do. And the work that it's doing is work that it's doing for you. Save for emergency savings while paying down debt. I've made this comment before. I really believe it. It stops the cycle of you're paying down all that debt and all of a sudden you need new tires for the car and you don't have any cash on hand. So now you're putting it right back on the credit card. And that does two things. It makes you feel badly that you're not getting further ahead, and it adds that money back onto your credit card. So you're right back in the same spot. So pick a number, 3 to 6 months, and just start chipping away at it. Put some money into that emergency savings account separate from anywhere else. And also plan a short-term reward to keep you on track. So if you really want to go camping or you want to take a trip to Mexico, start putting the money aside for that. And once you hit it, reward yourself. That will keep you on track. Getting into debt, sometimes those things are out of our control. Things can happen. And then once we're in debt, it can feel like a real struggle to get out. So really make sure that you're connected with your goals, and paying off a debt isn't a goal. That's an outcome that you want to achieve, but reward yourself for paying off some debt. So build that right into your structure. Thanks for sticking it out. This is one of the longer ones of my financial pyramid series. And as you know, if you walk through this whole pyramid from top to bottom, touching on everything that's listed, you're going to build yourself a great financial foundation and a super financial future. You will be able to make your decisions with clarity, and you'll know how pieces interconnect with each other. So every financial decision we make could affect another area of our financial wellness. So really important to be aware of that. I do financial coaching. If you want to reach out to me directly, feel free. I'm Maura from Do Money Like It Makes Sense. You can find me on LinkedIn. You can find me on YouTube, and happy to help in any way I can. Always wanting to forward great conversations about money and make people feel comfortable talking about money. Again, have a great day, and thanks for joining me.